Welcome to Real Estate Roundup. I'm Emmanuel Romanis. As always, if you want to contact the show, you can simply send us an email at realestateroundup@outlook.com. Again, that's realestateroundup@outlook.com. Joining me a little bit later on will be a good friend of the show's and my own personal friend, Jennifer Burnett from Pennsylvania Preferred Mortgage Company. As you may remember, she was on the show last year. And big difference in interest rates in mortgage markets between last year and this year. And I thought it was a great time to bring Jennifer back on because she is indeed the expert in this area and to talk about what's going on, what some of the changes are. And that's what today's show is going to be about. It's going to be about mortgage rates, and we're going to focus primarily on that. So as many of you may be aware, in March, a couple months ago, the Federal Reserve, the Fed, raised interest rates for the second time in 3 months and is sticking to its forecast of 2 more likely rate hikes this year in 2017 and a projected 3 rate hikes in 2018. Yet, there are some economists who predict that the Fed will put the brakes on additional rate hikes at least for the remainder of this year. Bill Connerly, who's a senior fellow at the National Center for Policy Analysis, summed it up this way. There's just too much policy uncertainty toward foreign trade, immigration, and health care, which will cause businesses to drag their feet on discretionary spending. Who's right, who's wrong? Not sure. That's part of why Jennifer is here, to maybe shed some light on that. So with that, that brings us to our recurring segment, Who Knew? And this month, the Who Knew question is, many first-time homebuyers have only known historically low interest rates. How widely have mortgage rates in the U.S. fluctuated over the past 44 years? The answer when we come back. Stick around.
The time is coming. There's no escape from the day you retire. And will you be ready financially?
Are you ready, dear?
Saving for your financial future doesn't have to be a nightmare. Choose to save.
Okay, welcome back. Well, we posed the question before the break. Many first-time home buyers have only known historically low interest rates. How widely have mortgage rates in the U.S. fluctuated over the past 44 years? Well, according to Freddie Mac, the average annual rate for 30-year fixed mortgages between 1972 and 2016, the lowest rate during that time span actually was last year in 2016 at 3.65%. Now again, this is the annual average rate. The high was back in 1981 at 16.63%. I remember those days. I was buying my own home back then, and I got a 9.75% rate that I was able to assume. It was an FHA loan on an existing home, and I was ecstatic at 9.75%. I thought I got the deal of the century. The 44-year average, again between 1972 and 2016, is 8.46%. So again, as you can see, since the bubble burst back in 2008, rates in this country have been at historic lows. And they're starting to creep up, modestly, but they're starting to creep up. And again, we're going to talk to Jennifer, who's the expert, to give us an insight as to what that is doing to the market. Now, to give you a little bit of perspective and balance as to how rates in the U.S. compare to the world, the international real estate broker Trineo has done a study, and in 2016, according to their study, the top 5 countries with the lowest fixed mortgage rates were, in this order, Japan, Switzerland, Finland, Germany, and Luxembourg. Japan was at 1.68%, Switzerland 1.75%, Finland 1.83%, Germany 1.9%, and Luxembourg at an even 2.0%. So you can see, even with our historic low in the U.S. of 3.65, we're still fairly above what some other countries in the world are offering money for. Who knew? So with that, we're going to turn it over to our good friend, Jennifer Burnett from Pennsylvania Preferred Mortgage. Jennifer, welcome back.
Thank you.
Glad to
Thanks
have
for
you.
having me.
Absolutely, absolutely. Let's start with the basic premise. Typically, conventional wisdom is when interest rates start to go up, markets slow down because people don't want to pay more for money than they have to. Again, as I had mentioned earlier in the show, some economists say that actually the reverse happens, and some of the things that they cite, Jennifer, which I'm sure you know better than I, number one is consumer psychology. A large pool of home buyers only know historically low rates. When they see them start to creep up, it'll push them off the fence to make them act now so they don't get tied into an even higher rate. Another one, too, is lending standards, and this is what you deal with on a day-to-day basis, where higher rates possibly give lenders more incentive to give out loans. The refinance market will dry up, obviously. The investment market will dry up, flippers and things of that nature. So some lenders will try to offset those losses by offering more purchase loans. Again, 2 schools of thought. So let me ask the expert. What is happening in the market? What are you seeing with regard to mortgage rates? How is it affecting the residential market? Let's start with that.
Sure. So I tend to agree with what you've stated so far. What you're seeing is people are kind of hopping off the fence. First-time home buyers, people that have been renting, they see the rate increase, they're like, oh, I better hurry up and purchase. Or maybe it's a family who owns their home currently and they know they need to make a move in the near future, whether it's to a bigger home because they have a growing family, or they want to be in a better school district because they have children that are coming of school age.
Sure.
So you see a sense of urgency from that aspect. However, on the flip side, we do see where homeowners now that might have, hey, rates are so low, let me toy with the idea of upgrading or downsizing and moving or what have you, are now tending to hold tight because there's some uncertainty. They're comfortable in their home,
right.
They're holding tight, and what is happening in the marketplace is I have an abundant amount of qualified home buyers. They're pre-approved, they're ready to go, they're serious, and there's no inventory.
Okay.
Very, very low inventory. So it's either they can't find a home they like to even entertain making an offer, or they have, and it's a multiple offer situation.
Okay.
A couple years ago, it was rare that you were in a multiple offer situation.
Right.
Last year, we did see the multiple offer situation activity pick up. This year, it's most clients are in a multiple offer situation. I have some clients now, we're on their 5th, 6th offer on a home.
And again, the catalyst of that is inventory is so tight.
Right,
okay.
Exactly. So when a home comes on the market, and I feel in this area from 200 to 450, 500, You're seeing if the home is priced right, it's in a good area, it's going off the market in a couple days, and it was multiple offers.
Okay. I don't know if you had a chance to look at, we were talking a little bit earlier, but when you were here last year, what are some of the differences in rates between then and now?
Great question. So I did actually look into that. Last year, April, rate average with Fannie Mae was 3.72.
Okay.
That was the average rate that month. This year, we're like 4.125.
Okay.
So I actually did the math on an example to put that to terms for you all. On a $200,000 home purchase with 5% down, so financing $190,000.
Okay.
The difference in monthly payment between the two rates last year and this year was about $30 a month.
Okay.
So while rates have come up slightly, it's not a huge difference. It's not a game changer. And I want to, be clear, because there is that notion out there, oh my goodness, rates are going up, we got to hurry up.
Right.
It's crisis, and
Sure.
they have, but it's not as significant as one may think.
And I've noticed, and I'm sure you've seen this as well, the rate increases that we're seeing, at least thus far, have been fairly modest.
Yes.
And at least from what the Fed is saying, now you never know, things can change on a dime, but it seems like they typically take a very cautious approach, and any future rate increases, and I'm sure there will be some eventually, are going to be modest as well.
Yeah, it's steady increase,
Okay.
an eighth here, an
Right.
eighth there.
Right.
I will say, at the beginning of the year, the consensus was, by the end of the year, 2017 will be around 4.8755%. Now that has kind of adjusted.
Right.
The theory tends to be that rates have gone up a little bit and they're going to hold tight.
Okay.
Through the end of the year. We might see ever so slightly, like again, just another eighth
Right.
increase because there's so much uncertainty out there with foreign trade.
Sure.
And so I tend to feel that rates are going to steady.
Yeah, and
through the
I
rest
have
of
to
the year.
agree with that assessment. Now, have you seen any difference, or is there a difference in the commercial market when rates go up or down as opposed to the residential market? Does it affect those markets differently?
I primarily deal with residential real estate. However, when you're purchasing a home on a residential aspect, that's sometimes your largest investment, your
Right.
biggest purchase.
Right.
So I think the rate increase tends to impact residential more so than commercial.
Okay.
Because on commercial, it's business, it's tax write-offs, it's tax advantages.
Right.
It's, we have to grow the business, we need a larger location or a better location.
Okay.
So I tend to think, I'm sure it impacts it,
Right.
when anything increases, there's an impact, but I don't believe as much as residential on
Okay.
commercial.
And that seems to make sense. I mean, I do a little bit of commercial work, but on the finance side, I don't really get involved in it, and I don't know that much about it. Now, you mentioned earlier about the rental market, that it negatively, higher interest rates can negatively affect that. Can you go into a little more detail about how that works and what impact that is on the rental market? Because I know a couple years ago, the rental market just boomed.
Yes.
When
Oil
mortgages
and
were
gas.
tight, lending was tight. A lot of these first-time home buyers didn't have the down payment. They just couldn't get the financing, so they had to rent. What's happening now that interest rates are starting to creep up with the rental market?
So, here is my thought on that. Just like when the guidelines tightened up and the pool of qualified home buyers, shrunk.
Sure.
So yes, that increased rental. I think unfortunately the same thing is going to happen here for a different reason. Again, there are people that I have pre-approved that are relocating here that are living with their parents and want to move out into their own space,
Right.
and they're wanting to purchase, which is the smarter move. but they can't find anything.
Right.
So I think naturally, what are they going to do? These people are going to rent until they find something. Relocation, they have to find a place here.
Right.
If they can't, they're not going to just buy something to buy something. They're going to make sure it's the right fit for them.
Sure.
So they have to rent. People that are growing up, they want their own space. They want to purchase. I think they're going to end up renting. So I think we're going to see an increase in rent.
Okay.
If inventory doesn't pick up.
So if I understand what you're saying, it seems like the tight inventory actually has a bigger impact on the rental market than interest rates necessarily would. Okay. And of course,
Right.
the two go hand in hand.
Right.
But and that would make sense, supply and demand. If I can't find anything to buy and I want my own place, I have to rent. I have no choice.
Right. And that's where, it's really concerning.
Okay.
Because the smarter decision with tax write-offs and
Right.
everything is to purchase. These millennials, these first-time home buyers, they're doing their education. They understand that purchasing makes sense. But if they can't find a home.
Right, right. Are there any changes within the mortgage industry as far as down payment amounts, things of that nature, money you have to come to closing with, that is related directly to interest rate fluctuations, or is that pretty much a separate issue?
I believe that to be a separate issue.
Okay.
What I have seen, Fannie Mae has come out with first-time home buyer 3% down, which is low down payment, as opposed to 5%,
Right.
which is what it was. So you could attribute there's a loosening of guideline there. And then PA Preferred Mortgage actually has a exclusive Fannie Mae product.
Okay.
It's called the Home Power Plus, where whether you're a first-time home buyer or not, you can put as little as 3% down.
Okay.
You get deduction on the mortgage interest, the mortgage insurance, excuse me.
Okay.
And also, if you complete an online education course, it's a couple hours. The cost to take the course is $75. We, the lender, give you 1% of your loan amount towards your closing costs.
Really?
Yes.
That's huge. That is huge.
It's a great program.
This is for first-time home buyers.
Nope.
For anyone.
For anyone. 3% down will give you 1% of the loan amount towards your closing costs. So in the example I referenced
Wow,
earlier,
that's awesome.
if you're financing $190,000, we're going to give you $1,900
Right.
towards your closing costs. And sometimes the rate tends to be a little lower than your traditional Fannie Mae conventional loan.
That is fantastic.
Yeah, it's a great
now
product.
the course that they're required to take, what does that entail? What type of course is it?
It's just a home ownership
okay.
course, just educating them on home ownership, finances,
Okay.
Managing your
I
finances.
mean, it's not going to be advanced trigonometry or
No.
calculus, something like that. Where
Not at all.
You're not getting your
Yeah,
1%.
never mind, no.
That's a heck of a program. We have a lot of questions routinely, and I know we talked about this when you were here last, but I want to review it again because, again, it's big on the minds of our viewers. FHA and VA loans. Can you briefly just go over what those are and how they work?
Sure. So FHA is a government-backed product by Ginnie Mae. It's a 15 or 30-year fixed-rate mortgage. You can put as little as 3.5% down, and you can ask for up to 6% seller assist. And that's when the buyer is asking the seller to assist them up to 6% of the sale price with their closing costs.
So in essence, the buyer is financing their closing cost.
In a way.
Okay.
If they get the home for list price with the seller assist, they're technically not financing it in. If they have to go above list price to get the seller assist, then technically yes, they'd be financing it in.
Okay, gotcha. Now, what about a VA loan?
VA loan is one of my most favorite products out there. For the veterans, if they're eligible, You can go up to 100% financing.
Okay.
There's no mortgage insurance, and oftentimes it's the lowest interest rate out there.
Okay.
And traditionally, that's a 15 or 30-year fixed rate mortgage, and you can ask for up to 4% of the sale price in seller assist.
Okay.
And you can also ask the seller to pay all non-reoccurring closing costs, all non-reoccurring fees.
Now, does the seller have to agree to that, or that's just an
Negotiated.
option that you have? Okay.
Yep,
That's
you
an
can
option
ask
you
for
have.
that. Yep.
Okay. Now, with the VA loan, is that relegated only to veterans, or does that transfer over to their families? For example, I'm a veteran, but my son is not. Would he be eligible for a VA loan, or it's only for me?
I believe it's only for you.
Okay.
And I'm not certain on that. I've
Okay.
never had that question. The reason why I lean more towards it's probably only for you is because I know when you have a couple,
Right.
if they're not married, the partner cannot be on the loan.
Okay.
So
I
with
mean,
that
that would
type of
certainly
guideline,
make sense that it's only for the veteran themselves.
Right.
But, like with auto insurance, sometimes it goes to
Right.
the family.
or even for college and stuff.
Right.
I know that
yeah.
can be transferable.
Right,
So
right.
I'm not certain.
Okay.
I'll look into that.
Well, if you're a veteran, ask. 'Cause we're not 100% sure, but we're 98% sure. What about jumbo loans? The term jumbo loan. What exactly is that?
So that amount recently changed. And last year, the maximum conforming loan amount before you crossed into jumbo was $417,000.
Okay.
It is
The amount financed, or the
Right.
sale of the house.
the amount financed. Great
okay,
question.
okay.
Yep. Now that loan amount threshold has come to $424,100.
What an odd amount.
I know.
Okay.
So when you exceed that, then you're considered in a jumbo mortgage.
Now, are there any advantages of a jumbo mortgage as opposed to just a regular conventional, or?
The biggest advantage is it's the lenders that offer them are saying, hey, look, we'll take a risk and finance this large amount for you. So the advantage would be less of a down payment.
Okay.
If there was not a jumbo option, anything financed above, the delta between financing 424.1 and the sale price would require to be paid at closing.
Okay.
So it does open up the market, if you will, the financing market.
Okay.
I will say at PA Preferred, we're very fortunate. We have a lot of good jumbo products where you can do as little as 10% down, which a
Okay.
lot of people, it's a hard line, they require 20%.
Right.
So we can do as little as 10% down. And then also, sometimes, depending on how the rates fall that day, I mean, they fluctuate daily, the interest rate is right in line with conventional or slightly lower,
Oh, okay. Good.
is what I've found recently.
Good.
And with that, a lot of people have the conception that jumbo interest rates are higher, they're
Right.
very high, and they do tend to be a little higher, but we have some great products.
Okay.
We're very competitive.
Definitely something to look into if you're in that market, obviously.
Yes,
Okay.
absolutely.
Is there anything that you want to bring up that you think is relevant that we haven't touched on?
You want to definitely be proactive in getting pre-approved.
Okay.
If you're embarking on the home buying process. You want to talk with any loan officer and real estate agent you're using to see how are you going to set me apart in a market where inventory is low.
Okay.
For example, PA Preferred, we have a program where instead of making an offer with your traditional pre-approval letter like everybody else,
Sure.
we can take it one step further, collect their documentation, and issue them a commitment letter.
Right, and that's a big difference.
Huge difference.
I've used that with you in the past, and it does make a difference. It puts the buyer in a much more advantageous position.
Exactly, because they're communicating to the seller, hey, I've already been pre-approved,
Right.
everything's been verified, I just need to find a property.
Right.
So that's one way to set you apart. Another thing that's really come back that's a blast from the past is the heartfelt written letters
Yeah.
that the potential buyer submits with the offer, just expressing how important, how much they love the home, how much they want to be there to set them apart.
You know, it's funny you say that because I'm not a big letter writer. My wife is. And on every offer that she makes, we make, she always writes a letter. Always. And most of the time it works. Sometimes you'll get a seller that could care
They
less.
just want the bottom line.
But I'll tell you what, especially in the residential market, I must admit it does work. It does work. One thing I want to bring up that we talked about last time that I thought was kind of amusing. I had asked you, I don't know if you remember this, Jen, I had asked you about FICO scores. And, you know, you see all these advertisements, check your score. And I asked you, well, by checking your score all the time, doesn't that hurt your credit rating? And you said, no. The only ones that really affect your credit rating is from the big three, but these other ones, it doesn't really. And now I'm seeing commercials where they actually tell you, and it won't affect your credit rating. So I thought, geez, I whiz. Talk about coming full circle. Anyway, stick around. We'll be right back. Okay, welcome back. We have a little bit of time, so I want to jump to the mailbag. And Jen, I'm glad you're here because I'm going to have you answer this one. Because you're the expert and it's in your field. Sylvia from Bridgeville asks, I applied for a mortgage and there's a charge listed on my cost sheet for PMI. What is PMI? Jen, what is PMI?
Okay, PMI is private mortgage insurance.
Okay.
And there is, you know, the feeling out there, oh, I don't want to pay private mortgage insurance. I want to avoid it. So on a conventional product, when you have less than 20% down,
Okay.
private mortgage insurance is charged.
Okay. Now, the lending institution charges that? Who charges that?
The lending institution that you're working with will have various mortgage insurance companies.
Okay.
And they'll shop the best rate and give the best mortgage insurance rate.
And the mortgage insurance pretty much is for the lender to hedge their risk for default. Is that what it's for?
Right. So
Okay.
If you were putting 20% down, it's generally looked at as, hey, you've invested 20% of your own funds, so
Okay.
you're less likely to default.
Okay.
So the lower down payment, the higher the mortgage insurance.
Okay.
And what happens is it's exactly covering in the event of a default.
Okay.
That's what it covers. It really doesn't have any benefit to the buyer other than if we didn't have mortgage insurance, you'd have to put 20% down at all times.
Okay, so it's an advantage for the buyer if they don't have a lot of money to put down, and it's an advantage for the lender because they have more skin in the game, so they're insuring their risk. That's basically what mortgage insurance is.
Yeah, and I want to bring up one point on mortgage insurance. A lot of times people out there want to understand differences between conventional and FHA financing.
Okay.
One of the main differences with regard to mortgage insurance is on conventional. Eventually that mortgage insurance is going to terminate. It will automatically fall off of the mortgage payment.
Okay.
It's 78% loan to value.
Oh, okay.
On FHA, it's different. When you're putting less than 10% down on FHA, it's going to be on there the life of the loan.
Okay.
It's never going to come off.
So that could be a big difference for the life of the loan.
Exactly. That's why your loan officer really needs to, talk with the buyer. What's your short-term and long-term goals? Do you plan on being here short-term or long-term? Because that could be a deciding factor.
Okay.
If you do 10% or more down on FHA, even if you do 30% down, the mortgage insurance is still going to be on there, and it's going to be on there 11 years.
Okay. So the bottom line, Sylvia, is just like when I preach over and over again, shop for a good real estate professional because they are different even within the same companies. The same holds true with mortgage officers. Shop around because there's not only a big difference between lending institutions, but even within the same lending institution, there's a big difference between lending officers. And Jennifer, I've worked with her for many years. She's the best out there. Whomever you go with, shop around. Anything else?
No, that's it.
Cool. Well, thank you for being here.
Thank you for having me.
Thank you for watching. That's a wrap.